Gold had a spike, 5,500. But that's it. It's the top. It's all downhill from here. The bull market's over. It's going lower. Time to get out. Et cetera, et cetera. That's one narrative. I don't agree with that narrative, but I hear it and I understand it. My view of what's going on, I think the data supports this, are a couple of things. Number one, it's a commodity. And I talked to, I know I've mentioned on your show before, but it may have been years ago. I talked to Jim Rickards, one among others who think it's going up a lot higher. And that continues to be my view. But when you see something like that, it's just a little hyperbolic there. And so it's pulled back. But if you date it from the high, not the start of the year, it's at this point it's over 20% and could be a little bit more. That's a pretty big drawdown. When I look at things like that, I don't get too euphoric when it's going up. I don't get too depressed when it's going down. What I do, I look at it and I ask myself why. Because if I can answer that question, I can figure out what's coming next. So the one narrative, which I don't agree with, by the way, but it's out there, is that, okay, I think both things are true. I think it is a shakeout and there are some structural things going on, which we can talk about it. So Danielle, you said down 5% year to date. And of course you're right, but it's down 20% from the high. Now the high was January 29th. So there was January was crazy. We all enjoyed the ride, but it was almost going hyperbolic. When you see that, I'm all for it. I own gold and I recommend gold, but you do take a beat and say, well, I'm the one who, what about the strong hands? The strong hands are central banks, institutions, and others, but let's focus on the central banks. They've been net buyers since 2010. From 1970 to 2010, 40 years, central banks were net sellers, not the same central bank in every case, but they were net sellers. Beginning in 2010, central banks became net buyers, led by China and Russia. In 2009, China and Russia each had 600 metric tons of gold. Today, Russia has about 2,500 metric tons, so they're 4 times. China has 3,000 metric tons, so they're 5 times. That they acknowledge very likely have more, when no one knows how much more, but they could have 6,000 or 7,000 tons. But Kazakhstan, Turkey, Japan, Mexico, believe it or not, Vietnam, these are all net buyers of gold. So that was one of the factors driving it up. In markets like gold, you have what they call weak hands and strong hands. Mm-hmm. Weak hands, when it's 5,000, I'm going to jump on the bandwagon, get some, buy some, and then it goes down like, oh, sell, get out. They buy high, sell low, great way to lose money. But the weak hands have to get flushed out, and that's happening. Percent, round number. And it's been going up ever since. It's gone up 5 times since then. So what we're seeing now is when you get into, Mandelbrot said, I don't want to get too in the weeds in terms of mathematics and so forth, but in complexity theory, in complex dynamics.
Jim Rickards says the market has 2 players, weak hands and strong hands. Right now, the weak hands, the scared retail investors, are panic selling at a loss. The crash is just a temporary cleanup to flush them out of the market.
Systems and physics and Mandelbrot's understanding of, it's fractal mathematics, basically fractal mathematics. And of course, when you're doing computations like that, you have to pick a base, and that can be arbitrary, but I picked $250 an ounce, which was 1999. That was an interim low versus, 800 in 1980. But it had got as low as $250 an ounce in 1999. And that's when Gordon Brown, who was Chancellor of the Exchequer, sold about a third of the UK's gold at $250 an ounce. I wish I'd been lined up to buy some, but that's referred to as Brown's bottom, because Gordon Brown managed to hit the bottom of the market, and it took off from there. But if you use that as your base, so it's okay, 250 is my base. It gets to 1900. Okay, so that's basically 1750, I think, or 1650 is the change. Okay, so 1650, so 250 plus 1650. There's your 1900. So what's half of 1650? Well, it's 825. Well, you take 1900 minus 825, and you're down around 1100, and the bottom was 1050. In other words, what happened was exactly what Jim Rickards predicted. It was down 50. By 2015, it was 1050. But I talked to Jim somewhere in the middle of that. It was kind of gone from 1900 to 1300 to 1200 or whatever. And he said, Jim, I own gold. I'm holding on to it. I buy more occasionally. But no commodity, these were his exact words, no commodity goes to the moon without a 50% drawdown along the way. He said, if you're in this market, you need to expect that. And I made a note of it, and then I saw the bottom at 1050. That was December 2015. Was that bottom? There's something called scale invariance, and scale invariance means that the same patterns exist over and over at different scales. They can be bigger, they can be smaller. Is that you have to have these 50% drawdowns along the way. He's right, but when they happen, you're on the launch pad. You are ready to go to the moon. You're ready for the $6, $7, $8,000 numbers I've talked about on your way to 10,000. So all the more reason to hang in there. So that's a mathematical volatility and commodity driven analysis. It's a great buying opportunity. This looks like a really good entry point. So the point is, like, okay, not a lot of fun, but if you bought it at 1,000 or 1,300 or 1,500, you're still well in the money. Number one. Number two, if you bought it at 5,000, hang on, it'll come back. And if you haven't bought it or haven't bought it, you have a great entry point. So could it tick down?
Jim Rickards breaks down the heavy math. He points out a golden rule by billionaire Jim Rickards: no commodity goes to the moon without a 50% drop along the way. History proves it. Gold crashed 50% in 2015 before exploding to its recent peak. This current dip from $5,500 is following the exact same mathematical pattern. Gold is just crouching down, getting ready to launch straight to $10,000.
4,000, yeah, but we're right around the bottom in my view. So I would say, ride it out and it'll come back, and it'll come back big. By the way, the other side of what Jim Rogers said, quite the opposite. If you don't have any gold, or perhaps you want to increase your allocation, we'll see. But my point is, it's not, as long as you can understand what's going on, it's not a reason to panic. It's not a reason to sell all your gold. I think it would be foolish. Maybe 1,800 is a good base. I mean, you just pick 2,000 for a round number and 5,000 for a high. The high is actually higher, and the interim base maybe 1,800, but just say 2,000 to 5,000 for a run. That's 3,000 points and $3,000 an ounce. And if you took half of that, 1,500. So from 5,000 minus 1,500, where would you be? You'd be around 3,500 if there's a 50% drawdown. Now, it was actually higher than that. I think the bottom is probably closer to $4,000 an ounce, but it's the same pattern, and it shows up from a chart. I'm not a technical analyst. I do look at charts for information. I don't think they necessarily have a lot of predictive value, but they are informative. And so, in my view, what we're seeing is a slightly smaller scale version of what Jim Rogers talked about. So you have to pick a base. Well, first of all, experience. He's had not just gold, by the way, every commodity, oil,
Right.
wheat, et cetera. I lived through the 70s, and oil went from $4 a barrel to $20 a barrel. That seems quaint by today's standards, but in real money, that was probably closer to to $100 today. But anyway, it went from 4 to 20, end of the world, et cetera. And then I remember, because I was in the bond market at the time, in 1986, when interest rates were still quite high. The Iran-Iraq war broke out. Forget Iran-US, Iran-Iraq. A million people died in that war, people forget. And the market was like, oh.
Jim Rickards gives a massive buying advice. He says even if the price drops slightly lower to $4,000, we're fundamentally at the absolute bottom. If you already own gold, just hold tight. If you want to invest, this is the safest low-risk entry point you will ever get. The bounce back will be huge.
Oil's going to the moon because they're going to close the Straits of Hormuz. All the things we're looking at now in the real world. They're going to blow up the oil wells and close the Straits of Hormuz and all that. And I said, and others said, the price of gold starts to come down. By the way, Danielle, I want to get back to the why. We haven't talked about that. We're doing the what and the how. We'll come back to the why, but kind of getting back to the what and the how. So what happens? So something happens. Gold starts to go down. So, people are watching. Okay, it'll find a new floor, and then it goes down some more. So now you're hitting stop losses. Traders, and now we're talking about leverage traders, hedge funds basically, and proprietary trading desks at Goldman Sachs or whatever. Their bosses are saying, hey, if you don't get out, you're fired, and so they get out. Okay, so that's more selling. So something started to go down. Now there's more selling because people got to close out. They got stop losses. Okay, guess what? More selling triggers lower prices, which triggers more selling because somebody else had a stop loss that was even lower than the one before. So that continues for a while. Now, along come the momentum traders, the CTAs, commodity trading advisors. They might not have been involved at all, but they're like, hey, here's a trend, jump on board, sell gold, sell gold. So that's all they do. They don't anticipate things, but when they see things, they jump on the bandwagon. So you just get a lot of selling that feeds on itself. So that's one thing taking it down. But there's something more important. When we've said many times on your show, Danielle, that the biggest driver of the price going up is central bank buying. And by the way, so let me just interject a quick another footnote, which is no, these guys are going to pump oil like crazy because they need the money. And oil actually went down to $6 a barrel from the 20 down to 6. So if I throw that as an example of there's a commodity down more than 50% from, well, you wouldn't use zero as a base. You got to pick your base. That's a little arbitrary, but there's a commodity that's down 50%. So he's seen it happen a lot. Number one. Number two, there is this mathematical foundation I talked about, which is fractal mathematics. That is how commodities markets work. He had seen it in other markets, but there's also a behavioral psychological element. So what about the strong hands? The strong hands are central banks, institutions, and others, but let's focus on the central banks. They've been.
Why did the price fall so fast? It's because of big institutional hedge funds. They use automated systems with a tool called a stop loss. When the price hits a low, computers automatically dump huge amounts of gold. This triggers a chain reaction, hitting lower stop losses one after another, creating a massive artificial spiral.
Net buyers since 2010. From 1970 to 2010, 40 years, central banks were net sellers, not the same central bank in every case, but they were net sellers. Beginning in 2010, central banks became net buyers, led by China and Russia. In 2009, China and Russia each had 600 metric tons of gold. Today, Russia has about 2,500 metric tons, so they're 4 times. China has 3,000 metric tons, so they're 5 times. That they acknowledge very likely have more when no one knows how much more, but they could have 6 or 7,000 tons. But Kazakhstan, Turkey, Japan, Mexico, believe it or not, Vietnam, these are all net buyers of gold. So that was one of the factors driving it up. The other one, mining output is flat. I'm not saying it's crashing. It's not. And I'm not saying peak gold, maybe, but I'm in the mining. I invest in mines. I talk to miners all the time. They say, can we find gold? Yeah, but it's getting harder. It's getting more expensive. The quality, the density of the gold in the ore is lower, etc. So supply is not crashing, but it's flat. Demand was going up. Well, that means the price goes up. This is supply and demand. You'll learn this the first week of economics. In markets like gold, you have what they call weak hands and strong hands. Weak hands, when it's 5,000, hey, I'm going to jump on the bandwagon, get some, buy some, and then it goes down like, oh, sell, get out. They buy high, sell low. Great way to lose money. But the weak hands have to get flushed out, and that's happening. They're not transparent.
Yep.
But some of the central banks are selling gold. Why? Russia has sold some gold. Turkey has sold a lot of gold. It's hard to know what China's doing. So that is what had been prevailing throughout this most recent run of the last 3 or 4 years. But you can go all the way back to 2009 with Russia and China. What changed? Well, right now, central banks are selling. They're still net buyers, but the net buying has dropped a lot. The closure of the Strait of Hormuz can't continue. It's not just prices. It's talking about shutting down South Korea, Japan, and Taiwan, and Australia, and New Zealand. So it'll break, but it could break in a good way or a bad way. But either way, then the price of gold will recover. Gold to get dollars to buy oil. If you want to know when gold is going to turn around, I would say gold will turn around when oil turns around, when the Straits of Hormuz are reopened or the war in Iran is over, and things start flowing again and the price of oil comes down. Or scenario number 2, the economy goes into such a bad recession that the price of oil goes down, not because the Straits of Hormuz are open, but because of demand destruction. People just drive less and unemployment goes up. You don't need any gas in your car because you're not going to work. So that is in the cards. One is a kind of good scenario, the war's over. The other one, the war's not over, but the economy's shutting down anyway. And that'll bring the price of oil back down. So if you said, okay, Jim, is this kind of retracement normal? The answer is yes. What's behind it? net selling by central banks, weekends, puking the gold, commodity trading advisors, trend followers, and stop losses. There's a whole bunch of dynamics. That's what's behind it. And when will it turn around? The answer is when the price of oil starts to come down. But that scenario has two branches. One is the war's over. The other one is the war's still going on, but due to the shortage of oil, the economy is shutting down. So this will turn around. It'll turn around, I expect, in months, not years, because Herb Simon, famous economist from the 1960s, once said, "If something can't continue, it won't." And the price strength of the dollar. Look at the dollar price of gold.
Yep.
When gold drops 20% in dollars, the reciprocal is the dollar went up like 25%. So we're in a strong dollar world, which means not enough dollars. And then again, inelastic demand for oil. So countries are selling to buy oil. It's that simple. When you take oil from 60 to 100 and you need oil, it doesn't matter what the price is. This is what economists call inelastic demand. Inelastic demand means you got to buy it no matter what the price is. And if you're paying more, something else has to give. You either have to cut some other spending or sell some assets, do something, but you must buy the oil or your economy is going to shut down. So with inelastic demand for oil at prices that have increased from $60 a barrel to $100 a barrel, where's that money coming from? Well, and by the way, U.S. dollars. Remember, we're still in the petrodollar world. I call it. I worked with the White House on petrodollar, the petrodollar deal in 1974, but now I'm calling it petrodollar 1.0. We're in petrodollar 2.0, but the basic dynamic is the same, which is if oil is priced in dollars and you need oil, then you need dollars. You can hate the dollar all you want. You can talk about the collapse of the dollar, the bond vigilantes, all this stuff. None of which is true, by the way. The dollar is getting stronger. And by the way, you want a good measure of
We get the real mystery. Geopolitical wars have pushed oil price to $100 a barrel since oil is bought with US dollar. Countries are facing a massive dollar shortage. To survive, central banks are temporarily selling their gold for quick cash, but Rickards predict this game will flip a few months. Once oil drops, gold will launch straight towards 6,000, 8,000, and eventually a jaw-dropping 10,000 an ounce.